Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, good to be here, Lee, as always.
Yeah, and this episode is particularly focused on AIM and small caps with three, not just one, but three stonking small caps to take a look at. Next 15 profit warning, which Fundamental is actually a holder of, so hopefully some good investing lessons there for the audience. It's very much an AIM and small cap focused episode.
Yeah, there's been a lot of news from the small cap AIM world. AIM stocks, lots and lots of news because you've had half-year results, you had trading updates. So there's loads of companies that have been announcing.
Yeah, lots of selling as well, hasn't there, due to the potential capital gains tax changes?
Yeah, we've seen that. We think that a lot of the small cap selling, a lot of weakness, have been maybe driven by fears over CGT changes, capital gains tax changes, even maybe some occasional potential change in inheritance tax, maybe putting some people off. But yeah, I think the small caps have been more effective than the large cap space. Well, you see it because given the illiquidity of the shares. But yeah, very much so. A lot of selling.
Maybe Philip Meeson, probably one of the biggest ones that comes to mind.
Yeah, that was a standout. Philip Meeson, the founder of Jet2, and he's a 17% shareholder in a 3 billion plus business. He sold 5 million shares, pocketing about 70 million quid. However, he still owns 15% of the business. He only sold 2 and a bit percent. So this guy is still well and truly aligned. And bizarre sort of rationale. He said the transaction has been driven by, wait for it, personal financial considerations alone. I'm not sure why else you sell shares in a business other than person that you own personally than for personal financial considerations. Again, it was a bit of an odd comment.
How much did he pocket from that?
70 million quid.
70 million. Wow.
He pocketed it. He won't have paid much from the first place. But he said he continues to be as a very substantial shareholder of Jet2 going forward. As I say, he still owns 15% of the business, which is worth £450 million in today's money. So he is quite committed. But yeah, he wanted to take some money off the table.
Yeah. So perhaps maybe that the selling that we're seeing is perhaps influenced by the potential capital gains tax changes with the Labour government.
Potentially, or Mr. Meeson's personal financial considerations.
Yeah. Moving on to Nvidia then. Someone posted a really nice comment discussing the CEO. He's been selling shares, hasn't he? And also there's been the investigation by the US Department of Justice over antitrust laws. You made a comment around the selling of shares that he's been making, and that were quite insignificant, really, weren't they? And the amount of shares he owns.
Yeah, it's not a huge amount. It's only 0.3, sold 0.31% of his overall stake. So it's hardly material in the grand scheme of things. His basic, I alluded to, his basic salary is just under $1 million, which isn't a lot for somebody running the third largest company in the world. However, if you chuck in all the stock awards, he gets about, I think they worked out, it's about $34 million a year. That's clearly meaningful. What he seems to be doing is now offloading a load of shares all the time. And these are all made through public announcements, through official channels. So there's nothing untoward in that regard. It's just unusual that somebody wants to keep offloading little pieces, like little parcels. Would it be better if he sold a big chunk, placed a big chunk of shares? Others have said, no, it's better the way he's doing it. I've read some commentary on this. But look, I hate the management selling. If management buy small caps, I absolutely hate it. But this is beyond anything we look at in terms of size. This guy's stake is currently worth $9 billion. He's getting stock awards each year, the equivalent of what he's been selling, or a lot more than what he's been selling. This is way off the scale that I can relate to. But what gets me is, what he's doing with all this money? He's selling it for cash. Where's it all going? This is just mountainous, isn't it? What do these guys do with it? There's big charitable giving going on. I don't know. Bit like Mackenzie stock, Mr. Jeff Bezos' ex-wife. She's been amazingly generous and very quiet with it as well, very modest and understated. But yeah, it is a bit odd. It is a bit odd, but it's not a huge percentage of his overall stake. So hard to really gauge much, in my opinion. I mean, the position of the stock concerns me more. I mean, its growth profile, how we're looking further out, how that's going to continue, if it can continue. And it's not surprising. You've got to look back at the history of this business as well. The shares absolutely chugged along, going nowhere. I think it floated in 1999. The shares have gone nowhere, and it's really until 2021. Then they popped up, they fell back again. So it's only been in the last 2 years or 3 years that it's really actually flown. They went nowhere. This guy was running a business and seemingly underperforming year relatively from a stock market perspective for a long time, for 20 years. So
Yeah.
his payday's come. Good
Yeah.
luck to him. What an incredible job he's done.
Is he just cashing his chips in now then after 20 years of
Yeah, a lot of chips. Even
Yeah,
after
yeah.
20 years, a lot of chips. But yeah, he's got a lot of chips left in the bank, hasn't he? So we will see. It's a very tough to gauge.
Should we move on to the small cap world then? We've got a few stonking small caps to update on, haven't we?
Yeah, we've had loads of news from small cap world. We've some of our small caps announced this week. Gamma Communications, lovely business, relatively unloved after the pandemic. It's really perked up. It's a provider of communications, unified communications, web-based communications across UK and increasingly Europe. And the shares move higher this week on really good results. This business, if anyone wants an idea of a terrific growth story, Gamma is a great example. It's grown organically from its own internally generated cash flow since listing. It's been a great success story and really a great example. Great margins, fabulous cash flow, no debt, been buying everything else out of from its own cash, which is just what we like to see. Good return on capital, return on equity. So yeah, I would implore people to look at Gamma and read our note, Stonking Small Cap note. The one disappointing fact from our perspective was they're eyeing a move potentially to the main market from AIM. They've been on AIM, they're listed on AIM, and they're thinking moving to the main market, which will impact its qualifying status for inheritance tax planning purposes. That is, assuming the Labour government doesn't withdraw the reliefs on inheritance tax planning. But yeah, that will be disappointing because it's been a great success story on AIM. Yeah, and we need more of them like that. And another one we had was hVIVO, a newer one of our stonking small caps. It's a leader in testing infectious and respiratory disease products using human challenge clinical trials. Again, it's a more recent success story, been doing really well. They came out with results which are very strong, good contract news. So another one to look at, hVIVO, very different to Gamma, but yeah, it used to be called Open Orphan when it wasn't as popular, but since its real focus in this challenge clinical human trials area, it's been doing very well. Finally, the third one of our stonking small caps, business called Keystone Law, nothing like the other two. Keystone Law, it calls itself a challenger law firm, but it's really a platform. It's not a legal practice in the normal sense of the word. It provides the platform that other lawyers can plug into. So if you're working in a big firm and you're very tired, you're fed up, you could effectively link yourself to Keystone Law, become a notional principal in Keystone Law, where you wouldn't have the pressures of the big business. And effectively, you'll be running your own little business, but Keystone will provide all the administrative infrastructure for you and the legal badge, the partnership badge. So it's pretty good. Terrific generator of cash, which is interesting from our perspective. It's still got the founder in there as well. He owns 20% of the business. So Keystone Law, another one of our stonking small caps.
So there's three good companies for the audience to take a closer look at, and that's before we've even discussed the rest of the companies in the episode. But if you do want to dive a little bit deeper into them, you can scroll down, you can click the link to join the Investors Champion platform. But one of the things that you did mention there, Chris, inheritance tax planning. And I'm sure the audience, if they're listening to this podcast, perhaps that's probably a consideration for them also. Would you mind expanding on your thoughts around inheritance tax planning and if you have any concerns that the Labour government may remove these tax reliefs?
It's a tricky one. Clearly, effectively, we've been paying more and more inheritance tax. So despite there being reliefs in there for inheritance tax, the inheritance tax take from HMRC has gone up. Now, there are thoughts that they want to try and extract even more, and particularly those very large estates that get away with more relatively than smaller ones. So proportionally, some of the larger estates in the HMRC's tax take isn't that great, considering their size. And one of a relief from inheritance tax can be gained through investing in AIM shares, which qualify for so-called business relief. And there's been a lot of talk of potentially withdrawing that. Well, possibly. This has been on the table for years and years. Ever since we've been investing in AIM shares, it's been on the table virtually every year. It was at its height when AIM was peaking. This was years ago when AIM was flying. People complaining, oh, there are 20 plus AIM companies worth $1 billion and more. They shouldn't have the tax break. Now they're only about 6 or 7 worth that kind of money. AIM shrunk a lot. if the tax breaks are taken away from AIM, it will be a big hit to the market because it's a big draw in terms of encouraging interest in smaller quoted companies, encouraging liquidity. And the market is there for liquidity to encourage active buying and selling. Without it, you would have few institutions would be interested in these small stocks. So it could be a challenge. Their shares would probably be weak for a period, and then you'll just see them taken over, quite frankly. You're seeing that at the moment. There is so much takeover activity among some of AIM's brightest and best smaller companies, and that will just accelerate. The private equity mob will descend and just pick off these stocks at rock bottom valuations because you'll see all the people owning the shares for inheritance tax planning being forced to sell, which will be sad. Clearly, we have our own vested interests, we as in Fundamental Asset Management, our associated investment management firm. And it would be a hit. Our view is some of the sort of mid-sized ones will probably be impacted more than the very larger ones. A lot of larger AIM companies have a pretty broad-based institutional holding. So it's not the concentration of IHT planning money is perhaps a bit less if you've got big institutions holding the shares, not just inheritance tax planning investors. But who knows? But yeah, I think it's a good relief, as I say, in our opinion, to encourage investment in smaller quoted companies. Without it, be less of a draw. There'll be a lot of sort of zombie companies from a stock market perspective. That's the risk. With little buying interest, that really is the risk. But also some great bargains. So we would implore people to be patient because you'll see some great bargains and be ready to swoop and pick them up. Should this relief be withdrawn, that is, which we hope it won't be the case. You're talking about $1 billion and a bit of tax in the grand scheme of this £22 billion hole, and with much easier areas to extract some tax, notably pensions. Capital gains tax is going to be a target, we think, obviously. But yeah, it's a relative trifle in the grand scheme of taxes that can be picked off.
Why don't they concentrate just as much on growing the economy, and then the tax take would go up and they'd get more
Well,
money in?
that's
Why
the
don't,
issue. I mean, you should enhance reliefs, if anything, to get more people in, more investment, unlock some
yeah.
of the capital there. A lot of AIM companies also got a lot of cash. They should be encouraged to invest. I'd rather they invested for growth rather than go through share buybacks and this rubbish. Buybacks are, yes, are good in some respects. They should be investing for growth. It's frustrating when a small company is buying back its shares. They should be ploughing it in to support growth.
Yeah, the government should be focused on growth as well.
Yeah, absolutely. Absolutely. Plenty of opportunities out there, lots of money if you look closely.
I agree. But anyway, let's not go down the politics route, but
Yeah.
hopefully the audience enjoyed your take on it. So moving on to the next company, Next 15 is a company in the
It
fundamental
does, yeah.
portfolio.
For our sins, we do own it, and we've had a difficult warning this week or recently on its results. It wasn't the results; it was a trading update, a bit of out of the blue, and really, it was just really poorly worded. And I would implore companies to look at their communication. And as this is a communication-based company, it's equally frustrating. Next 15 now calls itself a tech and data-driven growth consultancy, whatever that means. How is anybody supposed to know what that means? Absolute rubbish. And it's always the thing that annoyed me about it. Anyways, it's been a great success story on AIM. Still got one of the early management running it. I don't think he was the actual founder, but he came in at the early doors and he's been doing a pretty good job. But yeah, but its announcement was just terribly worded. It left just more questions than answers. So they're saying they weren't doing very well. In certain parts of their business weren't doing very well. A key acquisition they made has lost a big contract, which has impacted things. They're seeing ongoing weakness from their technology customers. There's very little guidance provided, so you're just supposed to guess, really. Anybody looking at this stock will say, oh, crikey, what is the impact? I don't know the financial impact. I haven't got a clue. So you have to wait till the brokers produce their notes, updates. Of course, they're not publicly available either. Yeah, we were just staggered at the lack of detail, as I say, from a company in the communication space. Anyway, the broker note ultimately determined it was a circa 25% downgrade in its profits next year, but the shares fell 50% on the news. I would suggest the other 25% of the fall was really down to just poor communication, which is inexplicable, in our opinion. And it didn't have to be commercially sensitive. They just had to give more clarity. They gave no clarity. It was just rubbish, absolute rubbish. But what do? You see shares fall like that as an owner of the stock. Do we get out and say, this is terrible? We think it's massively oversold now. I missed it. It's a decent cash generator, this business, and its technology customer base will come back. deal in question, the company that suffered this big contract loss, it was always a bit of the elephant in the room. You've probably now got a better balanced, forward-looking, effectively order book now than taking this one out of the equation or making it less significant. Yeah, it's just very frustrating.
So I guess, are you then now looking at the company as opposed to a selling opportunity, as opposed to a
Well, I'm
sell?
looking forward to the results statement when we're going to get more
When's that?
clarity, more color
When's
on this. I think it's a few weeks' time.
a
So,
few weeks?
yeah, it'll be interesting to see what they come out with, but just very frustrating.
So just trying to understand your process here. You'll wait then for further evidence, for further information from them before making a decision either way.
Yeah, because we feel at the moment it's oversold, massively oversold.
Yeah.
Effectively, not down to at the moment, our assessment, this isn't down to the performance of the business, the selling, the extent of the selling. It's down to really the extent of it on poor communication. The shares didn't look overly expensive before. They look pretty good value now. And we think management could do a better job communicating than they have. And we'll wait and see. That's often been the way lately. You've got pressures at the moment around a lot of selling in the small cap world for matters that we discussed earlier on. I think fear around tax changes, notably capital gains tax. A lot of people are seemingly taking money off the table. We'll see later at one of our companies where a director sold a lot of shares, and you're seeing a lot of selling, possibly for CGT planning reasons ahead of this budget in October, end of October.
More tax changes from the UK government
Yeah,
potentially having an impact on the share
yeah,
market.
yeah,
But,
absolutely.
some people in that situation may panic sell, they may buy, but you're sitting on your hands, wait for more information. The results are out in a few more weeks and then assess then.
Yeah, absolutely. And look, I wouldn't sit on our hands if we were concerned. But it was just,
Yeah.
the history of this business is it's delivered. It's delivered cash, profits, and growth, often organically generated, which is good from internally generated cash. Ticks a lot of boxes for us. This is a bit of a misstep and a miscommunication, at least. And perhaps in terms of action, perhaps the next one demonstrates it. A business called Inspecs. It designs eyewear and it's just disappointed. This business I just don't get it, the mess
Yeah.
it's in.
This has no track record of delivering, does it? Unlike what
No.
we've just discussed.
And we exited it for the vast majority of our book many months ago. But we've still got a little tiny legacy position. Liquidity hadn't been great. We were holding a sort of small legacy position in it, we as in fundamentals. So, what are our thoughts now? This is a business that generates circa annually around £200 million worth of revenue from selling lenses, frame, both through its own brands and in distributing others. But it can't make a bean. It's been grown through acquisition. It came onto the market less as a manufacturer, more as a designer. It's moved more into the complete offering of design, manufacture, distribution. It's made some acquisitions that have been messy, I can see haven't really moved the needle. And again, much like Next 15, its communication is just, I find, dire. The results statement alluded to a 1% improvement, gross profit margin improvement, is significant. 1% isn't very significant in my book, not for a business that's never made a bean. But it then comes out with revenue from travel retail increased 45%. But to what? We weren't told to what. What was the number? The revenue for the half year was 100 million. What does travel in there? We weren't told that either. Again, management was confident of meeting market expectations for the full year. We weren't given any idea, any guidance, whatever those would be. A lot of companies put a star, asterisk, and tell us what the guidance is. Consensus is A, B, C, X, Y, Z,
Yeah.
a range. We weren't given any of that. And this is for a business that has been a serial underachiever now since it listed. It's been a complete basket. It's become a basket case. We thought it was getting better. We thought management of surely when you're not doing well, the clarity should improve. You feel it should be forthcoming and show real control over the numbers. That unfortunately hasn't come out. I wish them well. I hope they can survive. But see, again, it doesn't seem commercially sensitive. They're telling us that travel's doing well. Tell us what that represents of the overall, rather than whether it's up 45%. 45% from what? 1.5? 100? It's smoke and mirrors all the time. It's like they think it's them and us. How much can we hide from the readers of the thing? We've got to make sure we don't say anything at all, really. Let's see how we can confuse them. All right, a lot of people reading this, they're going to be their shareholders. We're in the same boat. We're in it together.
Yeah.
Share it.
Maybe a good comparison for Inspecs would be to compare with Next, and Would be a good lesson, wouldn't it, for the investors?
The better next, not the next 15
So
days.
you are right, yeah.
Yeah, the good next PLC. Yeah, they're great.
Not next
They're
15,
terrific.
but
No, that's the irony of it, isn't it? Next PLC, the retailer, they're terrific the way they communicate. You get chapter and verse. They tell you why they're doing a share buyback, what's the rationale for it, etc.
brilliant. Another good lesson. Should we move on to Frontier Developments? Is that a company again that you own in the fundamental?
No, we've never known Frontier Developments. We've owned some other video gaming companies who've done quite well out of. They got taken over in the glory days. Another one hasn't done so well, but it's the quality operator in our opinion. But yeah, Frontier we've never owned. We've always been a bit wary of it, and it's again another business. Video gaming was very popular. It's now been a challenged area. It's been tough, and Frontier Developments produces some interesting games, but again, it's just been trying to do, in our opinion, too many things, and the cash flow is. You've got to look at the cash flow statement to get a good idea of this business and the free cash flow, because whatever it generates in operating cash flow, it's plowing back all the time into paying for new game development. And really, it's been challenging. So look at the cash flow and all the impairments they've now had to make on previous game development. The trouble is they produce some nice games, but they're costing an awful lot. Seemingly, if you don't have a winner out of those, out of all that game development, it's just down the tubes, down the drain, which has been really tough for Frontier. But they refocused in their core sort of area. They call it called a strategic reset. Let's see how they get on, because it's been a great sort of homegrown, Cambridge-based growth story, and be good to give it some time to see if this can work out.
What would it take for you to see the signs that this new strategic vision is working and it may become an opportunity to invest in?
I'm an investor. I've got to see the business that can make a viable return, a return on capital, a return on the cash it's investing. And it's got to keep control over its costs, therefore. That's absolute key. This business hasn't really, again, demonstrated any real cash profitability. I think only briefly in the heyday of video gaming, but then it's just replowed it back in. I think it needs to demonstrate consistent free cash generation and make things profitably. It shouldn't just be the creative industry, create for the sake of creation kind of thing. Games have to prove themselves commercially, but commercially means not just your revenue, but also your cost base as well. How can it all work? But yeah, I wish them well.
Yeah, agreed. My 13-year-old son plays a lot of the games that Frontier Development produces, Jurassic Evolution and Planet Zoo. And it's been really fun and interesting kind of explaining to him how there's actually a company, a listed company behind the scenes that produces this. And when there's DLCs on there and then they're selling them, and when he's buying them, that's contributing to the profits of the company and paying the wages of the developers. And so it's really been good educating him on the games that he's playing. There's actually a listed company behind the scenes. But anyway, we move on. And the next company is SigmaRoc, which is a company that you've had your eye on, but are finding it difficult to assess all these acquisitions.
Yeah, it's another business. We don't hold the shares. We never have done. We were interested in it. We keep an eye on it. We used to hold a business called Breeden, which was in the mineral space, which was on AIM. It moved to the main market. And SigmaRoc is a potential replacement in our portfolio of Breeden. It's a business that listed not long ago, but it's been really highly acquisitive, keeps on acquiring things. It's now calls itself a European lime and materials group. That's not lime the fruit, but lime as in limestone, from limestone, the mineral. And given all the adjustment, all the acquisitions, it's very hard to assess how well this business is doing. Again, you look at free cash flows. We like to look at what the real cash is, because that's real world, not fairy tale adjusted EBITDA numbers that anybody can produce. But when a business is acquiring all the time and then adjusting costs, and you can't really tell how it's doing. Every time you think you get an idea, it makes another acquisition and strips out more costs. So yeah, I would say it's very hard to assess SigmaRoc, and I would say it's very hard to assess any serial acquirer. At some point, the acquisition surely have to stop. You've got to see it coming through in free cash flow. And this business doesn't make, unlike Gamma, which we spoke about to begin with, where it's making small bolt-on acquisitions. Those are small ones from internally generated cash, its own cash and its own profits. Sigma keeps going back to, it's gone back to the stock market for some hefty amounts of new equity. So clearly its institutions believe in the story. So they've raised a lot of money, and it's got a massive debt load now. I think it's over 500 million of net debt. This is now a big debt load that it needs to demonstrate that it can generate plenty of free cash flow from this massively enlarged business. But yeah, I'm always a bit wary of these eye-popping acquisition stories. People that do these absolute humdinger deals like SigmaRoc's been doing. I don't mind the little bolt-ons. They're far easier to understand.
It's getting that balance right between growing enough and adding companies, but adding the ones that add value to them. Whereas,
Yeah, history has proved that these massive deals haven't added greatly to shareholder value. There may be exceptions. SigmaRoc proved to be the exception. It may go on to do great things out of it. But as I say, I think it from a practical common sense kind of perspective, wow, it must be a job, mustn't it, integrating these mega deals. Whatever you say you bought the business for, it's irrelevant because you look at all the subsequent so-called restructuring costs which come through, they're always huge. And SigmaRoc is also year after year. They always adjust them. And despite the fact that their business model is an acquirer, all these acquisition costs are adjusted out, which is just rubbish, isn't it? Absolute rubbish. There is still a cost to you as the shareholder, costing you as a shareholder money because you're having to pay for it. And it is a form of, to justify it as is effective means of comparing year on year is also wrong because you're just acquiring every year or every few months. And they've said
yeah,
they've got to clean it up and see what happens. So yeah, they might deliver. I wish they do. It will as well. It'd be great news.
absolutely. And a merger that happened not too long ago, actually, Property Franchise Group. How do you think that turned out?
Now, this one I'm in favour for. So two businesses, Property Franchise and Belvoir, they're in a similar space. Property, they're in the business of property franchise and they run lettings agents and they provide the platform for it right, through a franchise model. They're very similar businesses that came together. You've lost a whole load of head office PLC costs. Both were on AIM. Belvoir was on AIM. So you've lost a whole load of PLC costs for one. You've got a combination now. It's got a network of nigh on 2,000 outlets, which is franchisees are in, who manage in a network of 152,000 properties. So this is a really meaningful force. And property franchise didn't have much financial services kind of business, whereas does, which is great. So hopefully that'll benefit the property franchise group bit, the original bit. But yeah, this seems like a merger of equals that should be a case of 1 equals hopefully 3. I mean, right. So I'm firmly in favour of it. And in good news, I hope they do well. You've got a more meaningful business, 200 odd million market cap. That attracts more investors as well. So there are a lot of good reasons for these two coming together. And it wasn't just an acquisition, it was a combination. They've subsequently, the combined unit has done another deal, bought a group that includes Fine & Co. estate agents. The combination looks all powerful, which is great.
Does Fundamental own them?
Yeah, we've owned them for a long time, property franchise. We've held both, really. We held Belvoir, just our income model, and property franchise in both our AIM growth model. And yeah, we're happy holders. Clearly, it's become a lot bigger position as well through the growth in the share price and also the Belvoir bit adding to it.
Yeah, fantastic. And we're going to finish off with an AIM favourite, aren't we? Fevertree. One of the
Yeah.
big AIM success stories, isn't it?
Yeah, it has been, and it's really polarizes opinion. And we weren't in at the early days. We bought in when it sold off a bit. Unfortunately, it's been weaker since, and it's just announced results. And basically, overall revenue was broadly flat, and the mix of that was great growth in the US, 10% growth in the US market, but the UK and Europe were down. A lot of the reason for the UK and Europe being down was the poor weather at the beginning of the summer. They're saying that's improved now. The problem with Fevertree is that find me a few more companies growing, UK small caps growing double digit in the US. There aren't many of them. So Fevertree has really gone for the US market, the biggest in the world for its premium mixers. Seems to be doing a good job of it. When it first pushed into the US, it was stuck with higher freight costs, higher input costs with glass as well. So it's had a bit of a tough time, but it's still been growing meaningfully. Its distribution's growing. And it's growing, importantly as well from us, it's growing outside just tonic. This was all about tonic. Still represents a huge chunk of its business, circa 60%. But this business is more than just about tonic. Its ginger ale is growing really well in the US. It's got lots of other flavors coming out as well, which should serve it in good stead. But yeah, the shares got whacked. Its valuation is very rich. When a business is trading at circa times 30 times forecast estimates and is flat growth, and then guiding that growth will be lower for the full year, there's nowhere to hide. So the shares got whacked, but we still like the story. And we think there are a lot of reasons to encourage specifically the US growth and the rest of the world. This has never been about, for us, a UK growth story. It was clearly dominating the market. It wasn't going to grow much in the UK. It's all about just holding its share there and going into other product lines. This is all about a global growth play, and it seems to be making a really good fist of that. And we don't want to keep supporting it because I think there is real opportunity there.
What did you think of the communication from Tim Warrillow as well, the CEO?
Yeah, I
Better than
think
next 15, perhaps?
yeah, a lot better. A lot better. Not perfect, but a lot better. Tim always seems to upsell. He's good at that. That's his job.
Yeah.
He seems to focus on the positive rather than any of the negative. I think, in fairness, when a business is growing double digit in the US, he has some positives, and it has faced with all those costs, those input cost pressures as well when it's been trying to grow there. So yeah, I do sympathise. It's been tough for them. But yeah, summer finally came for the UK, a bit late, and so that's helped. But they've still guided. They were guiding for 10% growth. It's now going to be a lot less, 4 to 5%. So that's why the shares have been hit. But yeah, I think there's still a great growth story in there. And I think we should start seeing some really start moving both in the US and the rest of the world regions. We continue to be holders. I'd prefer it performing like Gamma, but that hasn't been the case. Yeah, it's got more to go, a lot more to go. It's not just about Tonic, and it's not just about the UK. So forget it if you're looking at this business from that perspective. This is about international growth.
That's been another really good episode with a lot of different companies covered, isn't it? Particularly focused around AIM and the small cap world. Some stonking small caps at the beginning there, 3 companies. A few varied lessons in there, profit warnings, how you handle that, how you handled that, shall we say, and your process and thinking. So hopefully another good lesson for the listeners. Thanks, Chris.
Yeah, thanks very much. Good as always.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.